Welcome back, and joining us for a look at the day's market moving news is Cremen from Adviceworx. Thank you so much for your time, Caroline. The JSE under some pressure today, kicking off the week on a sour note. One of the things was the Hong Kong court ruling for the liquidation of embattled property developer in China, Evergrande. Now, this has faced a lot of headwinds in the last few years. And I'm wondering what led to this ruling, but also if we should be surprised at all, considering the headwinds that this property developer has been faced with.
No, look, I think it was really just a formality in the end. You know, Evergrande issue started years ago. I can't even remember how long. And it was really one of the first property companies in China that really started to show a lot of distress, that had the potential to be, create a systemic issue. And I think what was interesting about Evergrande for everybody is that Chinese government did not jump in to hold it up. And it was the first sign that this government is, they're going to let these things fall in a relatively orderly way, but they are going to let them fall. A sign, that they're that confident. It's not a great sign for countries like South Africa, because we are commodity exporters. So, that whole weakness in that Chinese property sector is a problem, for us. We're not able to export our steel. We saw that in ArcelorMittal's results. It's just a general worry. But, in the end, it was just a formality for this company. I think the problem is in the last few months, you've started to see a few other names pick up, and certainly that lending for property is part of that shadow banking sector of China. It's very difficult to measure, and is potentially a source of systemic risk. And I still think is one of the potential black swans that could really derail, good markets this year.
Well, let's actually dive into the ArcelorMittal trading update for the year that they released at 4:30 today. We did see that share price plunging immediately by about 8%. They did say that they expect headline earnings per share to drop by as much as 179%. Of course, they did update the market on the headwinds that they're facing, but also the decision to close the Long's steel business. But of course, they're saying now that they have been engaging with a number of stakeholders, where it seems like there isn't a definite decision on that, but it's going to be quite difficult to keep that business open.
Yeah, I think, they can't say it's a definite decision, because, the law is that you do need to engage with all your stakeholders, your employees in the government, the local governments, and so forth. But, ArcelorMittal is really, it's not, I wouldn't say it's the best run company in the world, or even in South Africa, but, it's moving quite drastically from a relatively profitable position for the type of company it is to a loss. And there are a couple of things there. First of all, that loss is coming from the business impairment of the company of the entity they're trying to close down. But, it's just also they're looking at the general economy. They're looking at the decision, the conditions in China. They're having issues with transport and logistics, as we all, there was this whole infrastructure development that government had announced that I certainly didn't think was going to arrive. And ArcelorMittal first discovered that infrastructure expenditure has not arrived. And it's just really, everything that is wrong with our logistics and our infrastructure company comes down and is really reflected in what is happening at ArcelorMittal. And it is very worrying. And I feel sorry for them, because they're going to have to go and negotiate with government about this potential closure. And at the same time, it's that same government who really has not delivered, as far as logistics or infrastructure.
True.
So I'd love to be a fly on the wall at some of those meetings. I would find it difficult to be polite.
Yeah. Well, let's go into fashion retailer Truwords. They released their half-year trading update. Group sales rose 8.2%. But what was interesting is the divergence between Truwords Africa and Office in the UK. What were the focus points there?
Well, I think, Truwords Africa was relatively flat. They had a very good year, a very good half, the last half. So maybe, one shouldn't penalize them too much. But again, the UK business is still doing okay. These offshore businesses tend to do kind of okay when they start. It's how South African companies can maintain those offshore businesses. That's always been an issue. So that we'll see that play out in the long term. But again, True is also another bellwether of the economy. It is a credit retailer. And part of the reason, the great part of the reason why you're not seeing that growth in sales in Africa, South Africa in particular, is that the credit extension has not been there. About 70% of their book is on credit. They're looking at really constrained consumers. I think that, if I recall, that was what they actually mentioned. And so we're looking at constrained consumers, and to an extent, I don't think we saw at the beginning of last year. If you expected, interest rates are high at the moment, but it does again not bode well for our economy in 2024.
All right. Well, Caroline, let's get to your stock pick for today. What are you hanging your hat on?
Well, I'm going to be very conservative, and this is not for everybody. It is an exchange-traded fund. The code is QDIV. It is called the Global S&P 500 Quality Dividend. If you want to make oodles of money on capital growth, this is not the stock for you. It only did 5% last year. But the reason I'm recommending it for some people is that we're kind of in a bit of a market no man's land. Interest rates are probably going to be decreasing in 2 months, 3 months, depending on where your view is. You've really had just the big growth stocks really had a big blowout. I don't know about how much further they can go, if they can go further. So you're in a holding pattern. So some people are not able to access money market funds where you have that 4.5% interest rate. So this is a nice alternative because the companies are mainly in the consumer staples, the healthcare, and the industrials area. So it has about a steady 4% yield, and there's relatively little volatility in the companies that you hold. So I would always look at the money market proxy if you are not able to access money market interest rates overseas.
All right. Well, thank you so much for your time and for your insights on what has been driving investor sentiment today, Caroline. That was Caroline Cremen from Adviceworx.